Good afternoon to those of you on the central part of the United States, and good morning to those of you on the Pacific coast. We're really happy to have everyone here today for our nonprofit webinar series, and we are going to be talking today about non-traditional assets and donations of non-traditional assets. As Amy mentioned, my name's Kim Hunredson. I am the partner in charge of our exempt organization tax practice here at Eide Bailly. And I'm joined by Christine Perez, who is a senior manager also in our exempt organization tax practice. Christine and I are both part of our national tax practice at Eide Bailly and get the pleasure of working with organizations all over the country and with our internal practitioners all over the country. So with that, let's jump into our agenda. So first we're going to talk about what do we mean when we say alternative or non-traditional asset types? What kinds of assets are we talking about? And give you a little bit of an overview of some of the different things that are important to keep in mind with respect to donations of these types of assets. Talk about some of the benefits and risks of accepting these types of assets. We'll talk about the best practices with respect to both the accepting the donation, but then also holding and maybe managing those assets. And then we'll also talk about some of the tax reporting requirements that come into play with respect to these donations. So let's start off and dive into kind of putting some framework around what we mean when we talk about alternative and non-traditional assets. So when we think about our typical charitable contributions, we typically think of them in two different buckets. So we might have our cash donations and our non-cash donations. So our cash donations are going to be those fairly ordinary types of donations that you get. So your cash, checks, credit cards, those aren't going to be the topic of our conversation today. We assume most organizations that get those have procedures in place, know what to do, know how to report back to donors when they get those types of donations. We're really going to focus more on our non-cash donations. So really breaking that into three different buckets. So traditional, alternative, and then kind of our non-traditional. So dig into those a little bit more. So when we talk about traditional non-cash investments, these are things that a lot of organizations may already be receiving. So these would be things like publicly traded securities, bonds, CDs, things that donors may want to give you. They may want to, instead of just giving cash, they may say, hey, I have a stock that I'd like to donate to the organization. Again, a lot of organizations are accustomed to dealing with these types of securities. Oftentimes we see that these securities may be held once they're received by a donor, or they may turn around and you may sell it. And most organizations kind of have a process in place for what they're doing with that. The value that gets recorded for book purposes is typically going to be the value on the day of the donation or the day that it's sold. Oftentimes we might see that those just kind of hit the books, so to speak, as cash donations because you automatically turn around and sell them. But it is important to note that for tax purposes, so for your 990, we do consider those to be non-cash contributions. So that is something that we do have to report differently on the 990. And Christine will be touching on that a little bit later. Under traditional, we also have in there real and personal property. So that might be, a donor offers to donate a piece of land, or they offer to donate inventory or other items that maybe are going to be used in your exempt purpose. Maybe it's something that they have and they want you to take it off their hands. So, if it's land, if it's property, then you need to think about, well, what are we going to do with that? What's the purpose for us in keeping it? And we'll talk about some considerations on that a little bit later. When we talk about alternatives, we're really talking about investments that are not typically publicly traded types of investments. And these types of investments can cause all kinds of unique reporting considerations, both when they're donated to the organization, but then if the organization chooses to hold them, that brings a host of reporting issues. Again, we'll dig into that a little bit later. And then the last here is our non-traditional. And these are things that we're really starting to see come into play really within the last couple of years. I think most people are hearing more and more about virtual currency and digital assets and crypto type items. And so Christine's going to talk a little bit deeper on those types of assets, some of the considerations, some of the risks with respect to whether an organization really wants to accept those or not. And then the last one that we do see somewhat is life insurance policies. And these can be structured in a lot of different ways. This could be where a donor wants to give up ownership of a life insurance policy. So they're still listed as the insured, but the organization becomes both the policyholder and the beneficiary. In that case, there is a charitable contribution right up front. But the value of that contribution is really dependent on a lot of different factors with respect to, whether that policy is paid up, whether there's still additional premiums that have to be paid. And these types of donations really should be considered before they're taken. They might be a great payout to the charity at the end, but there could be some annual premiums that are still going to have to be paid. And unless the donor is going to give money to pay for those premiums, that then is becoming now a liability of the organization. So why might a donor reach out to you and say, I have non-traditional assets that I want to give you. I have something other than cash that I want to donate. Well, a lot of times it's reducing that donor's tax burden. So if instead of donating an asset, if the donor were to sell it and then provide you the cash that's remaining, they're going to end up in a lot of times paying capital gains tax on the sale or disposal of the asset. And then it's the proceeds less that tax that's available to be given to the organization. Instead, if the donor donates the asset to the charity, what we're going to find is that in most cases, the charity isn't going to pay tax on that gain. So 100% of that fair market value or that sales price goes to the charity. So the deduction to the charity is higher than it would be if the donor were to sell those assets themselves. This also sometimes can provide assets that could be used by the charity in exempt purposes. So I was just recently talking to a charity that had a donation of land that was going to be used to build a new facility. So they were wanting to build a new facility. A donor had land that was not currently being used by him. And so by giving that land to the charity, it's kind of a win-win. The donor gets the deduction and the charity now has land on which they could build their facility. So before we go any further into going in deeper into each of these types of assets and some of the tax considerations that need to be taken into consideration, I want to take a few minutes and talk about unrelated business income, because this is a factor that comes into play quite a bit when we're talking about these alternative investments. So just to put everyone on the same level playing field, unrelated business income is income that an exempt organization is going to need to pay tax on if the income is coming from a trade or business that's regularly carried on and is not substantially related to the organization's tax exempt purpose. So every time there's an activity that an exempt is conducting, whether it's directly or in some cases through another organization, we need to analyze that income from a relatedness to its exempt purpose to determine if the exempt organization is going to be subject to tax. If the organization is subject to tax, they're going to file a Form 990T to report the income. The tax is going to be paid at either corporate or trust rates, depending on the type of organization that it is. In general, I would tell organizations it's not a bad thing to have unrelated business income. It means you're making money. It just also means that you have to take into consideration that there's a cost to making that money, and that cost is the tax that you have to pay. However, if the organization has substantial unrelated business income activities, it can jeopardize its tax exempt status. And in this case, there's really no bright line test for what is substantial, but most practitioners will say, about 15% of the organization's revenues or activities coming from an unrelated activity could be jeopardizing. And there's some alternatives that you can do if you got into that situation. Where we see a lot of unrelated business income come into play is when we have investments in pass-through entities, like partnerships and S corporations, or as the result of debt finance property. So those are going to be things we talk about as we go through the rest of the seminar that we might make sure you keep in mind. So there is a general exclusion for passive income, and this comes into play for most of our investments. So to the extent that an organization is getting passive income like interest, dividends, royalties, rents, even gain or loss on the sale or disposition of property, that's going to be excluded from UBI. So when I mentioned earlier why someone might want to give a piece of land or property to a charity, this is the provision that excludes the gain on the sale of that property. So this applies across the board for most nonprofits. And I say most because there is some exceptions. This exclusion does not apply to S corporations or 501c7, C9, and C17 organizations. It also doesn't apply if there's debt financing on the assets or on the income. So debt financing comes into play if the asset was acquired by taking out debt. In that case, to the extent that there's still debt on the property, a portion of the income that's generated from that property is going to be subject to tax. So this would be something to keep in mind if, let's say you were donated a piece of rental property, and as part of that donation, there's a mortgage on that property that's also donated to you. And now the organization is taking in rental income. A portion of that rental income is likely going to be subject to tax because it's debt financed property. One thing to note here, private foundations, in addition to being subject to the general UBI rules, private foundations are also subject to an excise tax on their net investment income. So while all of our passive income is excluded from UBI, it is subject to a 1.39% in excise tax for private foundations. And then just to wrap up on the UBI, it's important to keep in mind that we do have siloing rules with respect to UBI. And what that really means is that to the extent that you have different activities, each of those activities as defined by traditional NIAC codes have to be siloed. So you can't use income from one activity to offset losses, losses from one activity to offset income from another activity. Now, when we're thinking about flow-through type income or income from passive activities, qualifying partnerships are all treated as one silo. And a partnership is a qualifying partnership if the exempt organization owns less than 2% of the qualifying of the partnership, or if it owns less than 20% and it doesn't participate in the management of that partnership. So again, as we talk through the next few slides about these different types of investments or types of donations, these will be things we want to keep in mind. All right, starting with the very non-traditional, or the very traditional. We're not going to spend a whole lot of time here. We're talking here about our investments, our personal property, our real property. The things to keep in mind if you are receiving these types of donations is just, are there any risks? Are there any other considerations that you need to think about? So for instance, if you're receiving real property, do you have all of the titles, the legal documents? Are there rental or lease contracts? If so, are you going to continue to rent the space, or are you going to not rent the space and use it for your own purposes? Another thing really to keep in mind is, what are you going to do with these assets? Are they going to be used for your charitable purpose, or are you going to end up donating them to someone else or selling them? So what's the purpose, and why would you want to accept these types of assets? The next thing we're going to talk about is pass-through entities. So these are our partnerships or our limited liability companies. And the key thing to keep in mind with partnerships and limited liability companies that are, and I should say limited liability companies that are treated as partnerships. So if you have a limited liability company and there's more than one owner, they can elect to be either treated as a corporation or as a partnership. We're talking right now about pass-through entities. So those are entities that are treated as partnerships. And for tax purposes, when you have a pass-through entity, the income flows through to the owners, and the owner has to look at each source of income and determine how it's going to be taxed at their tax paying level. So for exempt organizations, we would look through each of the items of income and we would decide, do I have unrelated business income or do I not? So to the extent that we have a partnership that is only generating interest or dividends or rental income, we're not going to have any unrelated business income because we talked about that exception before. There's that exclusion from UBI. However, if we have a partnership that's actually conducting a trade or business and we have ordinary income that's coming through, then we have to look at that ordinary income, compare the activity that's generating it to the nonprofit's exempt purpose, and determine if that income is related to the exempt purpose. And that analysis should be done at the partnership level, but oftentimes it's not. Oftentimes it's going to be up to the individual partner to make that determination. You will receive a K-1 from the partnership with the partner's allocation of all of the different types of revenue. And again, that K-1 should indicate whether there's any unrelated business income activities. But oftentimes, if there's ordinary income, that determination is going to have to be made by the individual partner. The other things that we can see with respect to K-1s is there could be transfers to other entities in foreign countries. So we're starting to see more and more complexity when it comes to especially investment partnerships, where you may take an interest in a partnership that has interests in all kinds of other partnerships or other activities, and all of that flows up from one level up to the next level and up to the next level. and it's the ultimate taxpayer who has all of the reporting responsibilities. So we're seeing more and more complicated K-1s that are showing, activities within foreign countries, which do require certain disclosures to the IRS. We have some listed here. So a 926, an 8865, a 5471, those are all triggered by ownership or transfers to foreign corporations or partnerships. And then we may also have unrelated business income. So definitely with a partnership or any of these flow-through type entities, you need to keep in mind that there is some long-term tax implications when you're holding those. We also have publicly traded partnerships. Publicly traded partnerships are partnerships where the ownership is really shares that can be listed on publicly traded markets. So these can become very complicated. These are the types of partnerships where, we might get a K-1 that's 15 to 20 pages long, and there's lots of footnotes and there's lots of information that's flowing through there. They might have multiple foreign jurisdictions. They might have multiple state jurisdictions. So there's a lot of information. And these cause complexity to your tax reporting. So while it might feel like that's a great donation to take, there's lots of upside opportunity, that's true, but you also have to consider that there could be some tax that has to be paid or additional reporting that has to happen. And then the last one here is with respect to S corporations. And this is a really key one to keep in mind, because a lot of people assume that S corporations, because they're a pass-through entity, are treated the same as partnerships when it comes to unrelated business income, and they're not. So while the income still flows through to the owners and it's still taxed at the owner level, and it flows through on a K-1, if you remember a few slides back, we talked about the fact that that exclusion for passive income does not apply to S corporation income. So in this case, all items of income, loss, and deduction are subject to UBI. So if someone wants to donate S corporation stock, you should be really cautious and really keep in mind that that is for sure going to cause tax liability. And then the last couple of things here are hedge funds and commodity funds. The real thing we want to make sure people are noting with respect to these types of investments is that these could be both foreign or domestic. And if it's a domestic investment, a lot of times it's going to be treated like the ones we already talked about. There's going to be passive income that flows through. Our foreign corporations, again, might just be generating passive income. However, to the extent that you're making, if you were to make any additional contributions into these funds, there can be additional foreign reporting that's required. These are also a little harder to get your arms around because there is no K-1 reporting. So a lot of times you need to get a prospectus or you need to get other information from the donor in order to truly understand what these types of investments are. So with that, I'm going to turn it over to Christine, and she's going to dive deeper into the virtual currency digital assets.
Perfect. Thanks, Kim. Yes, and with virtual currency and digital assets, this is really just a new area of interest that a lot of organizations are starting to research and look at, because the donations are becoming more popular, especially with a lot of kind of the younger donors or the younger age of people that are starting to give these type of alternative assets. I think a lot of charities just at this stage want to make sure that they don't miss the boat almost on accepting these donation types. These assets are not only held as an investment, but a lot of times we're increasingly hearing of these as almost like a transaction medium. And because of just the fast pace and the changes with respect to virtual currency and digital assets, most people really want to keep up and kind of get in the game before they fall behind. As of middle of this year, during 2022, this is about a $1.5 trillion market. And the number of crypto exchanges it's almost doubling, every year. So we are seeing more and more of these investment types. So because it is a relatively new area and concept, we've got a lot of nonprofit organizations that are asking questions. They're wanting to make sure that they can accept the currency and what the best way to do it is. We want to make sure that our internal policies are all updated in order to accept any digital assets, and then just making sure that we are reporting it correctly with respect to its status as a non-cash donation. And we are seeing a lot of these questions, and kind of put a note on here. It's because there are some banking partners of nonprofits and also financial advisors that cannot currently trade in digital assets or virtual currency. So a lot of times they might be blocked from actually discussing these investment types. So a lot of organizations are looking to external sources for some information. So when I talk about digital assets and virtual currency, we've got a lot of interchangeable currency or terminology, and that's what really makes this kind of a difficult concept maybe to kind of wrap your head around. And these key terms, honestly, they're used by a lot of people, and sometimes we're talking about the exact same type of asset. And other times we've got to pay really close attention and make sure that we understand the underlying asset type, because we could be talking about two different things. And I've got a few kind of general definitions here. So, in general, when we talk about a digital asset, we're talking about this digital record that's been created using cryptography and managed and stored electronically via the digital decentralized ledger. And really, this is a broad term for any sort of digital asset that's being used as a means of exchange, a good or service representation, or even as a financing vehicle at this time. When we talk about virtual currency, we are specifically talking about a currency or asset that's used as a medium of exchange that is also managed or stored electronically. So I want to highlight here that a virtual currency is a digital asset, but a digital asset is not necessarily a virtual currency. And that's key to understanding when people are talking or using these different terminologies when talking about the asset types. There are a lot of digital assets out there that don't necessarily represent a currency, but could be ownership of, say a music file, or that actually represent artwork at this time. And we'll talk about NFTs in a minute, and those are a different type of asset that we also commonly see. And typically these are pretty complex assets just due to the volatility, the risks of security breaches, and this general infrastructure that's required to accept and hold virtual currency and digital assets. The slide here. All right. So in the scope and context that we're talking about today, there are kind of three primary components that are going to identify digital assets or our virtual currency that's almost that kind of subcategory of digital assets. So the primary components are that it's a digital record that uses cryptography for verification and security purposes. So typically this means that there will be kind of the use of private and public keys in order to obtain access to the records or the account. Then there's the use of distributed ledger technology. So the big example here, of course, that people are familiar with is blockchain. It's a digital ledger that's public, and everyone has access to the ledger at the same time, so that you can see changes and updates to the value and ownership in real time for these digital assets and the currency. And within the ledgers, people are using kind of that digital wallet, and the digital wallet piece, these are set up and utilized by the individual investors or the asset holders to store, transfer, and receive that digital asset. Or if you're working with virtual currency, you would use it to kind of accept or donate or receive your crypto or your Bitcoin. And then the last component here, when I talk about digital assets, is the fact that they have the ability to be used for various things. So that could be, a medium of exchange, so buying and selling. They can be used as a currency. They can be used as a financing vehicle. So you can loan and then receive it back with these digital assets. And so at this point, the possibilities are really endless for what it's being used for out in the marketplace. And at this time, there are over 20,000 types of digital assets. So you can see that the use is really widespread. We've got some examples listed of the most common types that you'll probably hear of or see. And with respect to virtual currency, the IRS has previously released guidance to say that it is a donation of property. So, when you think of currency, normally you think of it as being a cash asset. The IRS has stated that it is a non-cash. So when somebody donates cryptocurrency to your organization, it is treated as a non-cash donation under Notice 2014-21. I'll notice that, the guidance from the IRS specifically states virtual currency, but overall, this is an area that's rapidly changing, and the terminology and the vocabulary can be different between different IRS publications and guidance that's being released. So, we go back to really understanding what the underlying asset is when you're looking at the rules and the guidance for reporting. So this is a quick slide that shows how we actually go about accepting virtual currency. So with respect to the ways that you can accept virtual currency or those digital assets, a lot of times we're seeing the transactions occur through the use of a third-party processor. So an organization can utilize a third-party service or vendor. That vendor will accept the currency on behalf of the organization. They would then convert the donation to cash and remit the donation or the cash back to the organization net of fees. The example here is the giving block. I'm sure a lot of people have heard of the giving block. It's becoming a very popular choice for a lot of nonprofits. This vendor, they assist with the setup of a link or what's called a widget. So donors will go from the organization's webpage, and then the giving block essentially hosts kind of a reporting dashboard for the nonprofit organization. The donor goes ahead and puts in their information to donate the cryptocurrency, and then the giving block or a similar type third-party vendor would then convert the cryptocurrency within seconds or at least within minutes to cash on behalf of the charity. Then they remit the cash directly to the organization's account, or what's called our wallet, less the service fees. A lot of these third-party vendors do provide all of kind of those back-end infrastructure and expertise in management of the digital assets on behalf of the organization. These type of vendors, they can also provide assistance with tax receipting and can provide assistance with some of our IRS forms, the forms 8282 and the 8283. They can provide some of that support to help the organizations generate those. So it's a really nice service and a good option for a lot of organizations that would like to delve into this area or in this area and don't necessarily have all of the expertise. The next bullet is for the wallet. And as I mentioned, you utilize the wallet to do that direct transfer of the cryptocurrency, the virtual currency, or the digital asset. And you can store, you can send, you can receive on the wallet. And it's a medium really to store the private keys and their associated public keys or blockchain addresses. There are many different types of wallets, but I think what we want to highlight here is that using that direct transfer to a wallet requires quite a bit of expertise. So it's not necessarily an item that we would recommend unless a staff member of the organization is really well versed in crypto. And then lastly, we do have donor advised funds just listed here as a way to accept currency, but we do have a slide further below that will talk a little bit about dApps and their use as a medium. So let's chat a little bit about a different asset type and non-fungible tokens or NFTs. These kind of they kind of blow my mind. They're a little bit strange, but we just wanted to kind of bring this up because they've become more popular, and having just kind of that underlying knowledge of what these are when you hear the term is really helpful. But we kind of want to get our mind around the concept that these are technically they're kind of built and held the same way that cryptocurrency is, where they are on the blockchain, but they don't represent currency that can be exchanged. So instead, an NFT represents a unique digital asset, or a signature. So the concept here is really that no NFT is exactly like another. So if we take a step back and we think about a digital asset, or when we talk about virtual currency, one Bitcoin equals one Bitcoin. Doesn't matter who holds it. They're kind of the same item that two different people hold, right? When we're talking about an NFT, we're talking about a unique asset that each person has. And it's coded so that the NFT that I hold will not be exactly the same as the NFT that another individual or investor holds. So really where the value is derived is having ownership of a unique digital asset that's exclusive to you or your ownership. And the examples we've seen a lot in recent years are digital art, music, GIF files, avatars, in-game items. There's even designer shoes and videos. I heard that some large companies such as Taco Bell have even used NFTs to raise funds for charity. So we're seeing this pop up in the marketplace, and it's just good to understand that this is completely separate from kind of those virtual currency. And they're definitely risky assets in that their value is completely derived as a function of the market for that NFT. So it could be worth something one day and worth zero the next. So there are some alternative options for holding non-cash assets, such as cryptocurrency or digital assets. And that's just because these are complex assets that do require quite a bit of setup and expertise. So, this is a viable option, perhaps if you're a smaller organization that does not have the infrastructure, maybe to set up or hold crypto, but you still want to accept. And so we've listed here donor advised funds. And what a donor advised fund, just in kind of general terms, we'd see it as a tool used by individuals, but they can also be utilized by anybody who wants to set up a charitable giving account, right? And the account or fund would be maintained and operated by a separate 501c3 organization that is the sponsoring org that acts as the administrator. So examples, Fidelity Charitable, Vanguard Charitable, Schwab Charitable, those are our big 501c sponsoring organizations. So they are the ones that would accept the non-cash asset on behalf of the fund that you have set up. These 501c sponsoring organizations, because they are so large, do have the means to accept all sorts of different transfers. So cash, securities, corporate stock, partnership shares. They can accept real estate assets, cryptocurrency, digital assets. So where an organization might not be able to accept it themselves, it is possible to utilize this. Your nonprofit would advise where the funds are being spent. So you would advise the donation of those assets once converted to cash back out to your organization. So just kind of an interesting way, maybe for smaller organizations to consider how to accept. And then next, we'll chat a little bit more. Another organizational structure that can be considered, this is the use of a subsidiary organization. And we'll see this a lot of times when an organization might really want to accept an asset, but maybe holding that asset themselves maybe poses some risk. So a good example is if you want to house one or more unrelated business activities that generate UBI, it's going to cause issues. The consideration of setting up maybe a for-profit subsidiary as a corporate entity to hold that asset it's a way that could potentially allow you to accept a non-cash or risky asset that you wouldn't otherwise hold in your primary portfolio. And then I'll turn this back over to Kim to discuss some benefits and risks.
Wonderful. Thanks so much, Christine. And yeah, I would say the crypto and all those virtual currencies really blow my mind too. I struggle to get my head around it, and think there's a lot of people that are in the same boat as you and I. So definitely, we have heard these questions coming from people with respect to, can I even accept it? Should I accept it? The answer is yes and maybe. I think from what you were saying, it really depends on the organization. So just quickly, and we've talked about most of these already, but why would you even want to consider accepting these types of assets now that we've talked through them? One big reason is portfolio diversification. So maybe this is a way for you to diversify your portfolio a little bit, moving out of some of the types of investments you currently have, maybe, moving into some rental property or some other things. Typically, an investment is going to have a higher rate of return than cash. Cash isn't going to get you much more than whatever you can earn from an interest standpoint. So there might be some benefit there. I would say the biggest reason, though, that we see this is from a donor relationship standpoint. If you have a donor that you're trying to cultivate and they say, I would love to give to you, but I would prefer to give you this asset versus giving you cash. Most organizations are going to do whatever they can to figure out how they can accept that asset instead of that donor walking away from them and going to an organization that will accept it. So, that's probably where we see this coming into play most often is, how do I keep a donor that wants to do something creative or something different? And anytime we have benefits, obviously we're going to talk about risks. So why would an organization not want to take that? Well, big reason for that would be if there's high costs associated with accepting the asset or withholding the asset. So, how are you going to dispose of it? Is it even a feasible asset to dispose of? If someone gives you some land out in the middle of nowhere, do you want to take that land if now you're going to have to figure out how to sell it, and you may have the cost of, realtor fees, or you have the taxes or other things associated with it? Do you have the expertise to even manage this? Christine talked about that with respect to the digital wallet, but we can talk about that with respect to just alternative investments. Do you have anyone internally that has the expertise to even know what you need to do to manage those assets? Again, if you don't have a way to accept the assets, that's going to be a challenge unless you can use some alternative method. And what if it doesn't align with the mission or the purpose of your organization? So think about an organization that is focused on the environment. Do they really want to accept cryptocurrency, which has such a negative connotation right now when it comes to the impact the crypto market is having just on the overall energy supply and the energy drain? So thinking about how would this look on the front page if someone saw that we took a donation of XYZ and how it relates to our organization. Then we'll jump into some best practices, other things to consider. Really before accepting a donation, I think these are all pretty self-explanatory with respect to, are there things you should know about the asset? Are you going to be able to dispose of it? And hopefully by the end of this presentation, you're going to understand, are there going to be additional reporting requirements or costs that need to be considered? From an oversight and review standpoint, who's going to manage the asset? What's the additional administrative burden? If you're taking on Let's say you're taking on some rental property. Well, who's going to oversee that rental? Are you then going to have to hire someone to be part or to oversee the day-to-day rental activities? Do you even have that level of expertise, even in your external advisors? So, is your investment advisor able to deal with the types of investments? What about your legal counsel? From a tax and audit professionals, do they have experience dealing with some of these alternative investments and alternative assets and how it gets reported on the financial statements or in the tax returns? What do your policies say? Do you have policies that even allow you to take those kinds of assets? Christine's going to talk a little bit about gift acceptance policies, which are really important for an organization to have and can really set the framework for what you can and what you can't accept. And that's a really great thing to have in place. If your organization's not real interested in getting that tract of land in the middle of nowhere, it's easy to go back to a policy that says, our policy doesn't allow us to do this, or our policy says it has to be approved by the board. It's an easy way for that gift manager to not have to make that determination themselves. Some things with respect to reporting. As auditors and tax people, there's all kinds of things that can come into play when you're holding different types of investments. So making sure you understand what impact does this donation, accepting the donation and or holding the donation have on my financial statements or my tax return. From a tax standpoint, will I be able to get information on a timely basis to be able to file my returns? If I need to get K-1s or I need to get investment statements, who's going to get those to me and how am I going to ensure that I get them timely? We talked about foreign reporting and other types of reporting. A lot of that isn't easily determined on a K-1, so there's going to need to be contact with that partnership with the investment advisor related to those investments. Does the donor have that information? Can they provide that information to you? And from a donor relationship standpoint, we'll talk at the end about some of the reporting requirements, but you really want to make sure that you're providing the donor everything they need in order to take a good charitable contribution deduction, because there's additional reporting for these types of assets beyond just the reporting you would do for strict cash type assets. And so the deductibility by the donor could be jeopardized if the organization doesn't provide the right information.
Perfect. So this slide just ties into some good governance policies and just that requirement for appropriate oversight of our assets of the organization by staff, the governing body or the board. Charities just really need to make sure that it is in their best interest to both accept and hold an investment or a non-cash asset. I've got two listed here, the gift acceptance policy, and then just making sure that those investment or financial policies are updated. Every organization is different. You might have multiple policies that kind of address or go through these. Maybe you just have the gift acceptance policy only and don't necessarily have a separate investment policy, or they could be all rolled into one large policy or grouping. But that best practice is really to make sure that the gift acceptance policy is reviewed and updated. And as Kim mentioned, it's providing guidance for your board, for your staff members, and also for the donors to make sure that you're really accepting a gift that is going to benefit the organization. And it does expedite that decision process, so you know exactly what you can accept and what you can't and why. And then just making sure that, if a policy is not updated, that it can result in confusion. It can result in assets that are misclassified or otherwise treated or held incorrectly by an organization. Or it can result in an asset that's accepted that should not have been, and now the organization needs to determine, the best way to manage or get rid of that asset. So a good example here, and we'll talk about this on the next slide, is policies and procedures and best practices as they relate to virtual currency and digital assets. So, here's kind of a listing of the best practices as they apply to, and in this case, I'm talking about virtual currency. So like crypto, Bitcoin. And as I mentioned, because we've seen a lot of interest here, we do have organizations starting to set up wallets, to start setting up accounts with the Giving Block. And we want to make sure that, you've got a good understanding of the best practices at this time. And the first item, of course, is just making sure that that gift acceptance policy does actually allow the organization to formally accept that gift of virtual currencies or crypto. And so the policy should also specifically mention if the virtual currency is to be converted immediately. This is highly recommended and is a best practice at this time due to the volatile and kind of unpredictable nature of these virtual assets. As well as the current lack of formal regulation for a lot of digital currency and digital assets. So what you don't want is an organization that does not have a policy, or the policy does not address crypto, and then you accept it with no policy or an outdated policy, and then instead of immediately, having the policy say, hey, convert it to cash because it's risky, it slips through and is held onto as a volatile asset and maybe ends up in like a loss situation. So, with a lot of these, because we're not well versed in crypto assets, right? It's new, it's changing. We really recommend utilizing a third-party vendor where possible to process and convert donations, and to also help you to manage the reporting. Do some research, look at these different third-party vendors. You can find, good lists. The Council of Nonprofits kind of has examples. If you work with a national organization, going up the chain and seeing what other organizations maybe in your local area are utilizing, that's always kind of a great place to start. And then, when you do utilize virtual assets, because they're out and they're public as to, who's transferring what, they are technically anonymous. And so you just want to make sure if you do accept an asset, try to have the donor come to you up front to say, hey, I'm donating this, and work with them. If you are using a third-party platform, there typically are ways to disallow anonymous donations, so that you would have all of the information that the donor is required to provide you for some of those forms that need to go out, or that you expect to receive for the high values, such as the 8283 or the 8282. And then our next slide here. This is just a quick slide that provides a few considerations that are specific to private foundations when accepting non-cash assets. It's just a reminder to review assets and potential donations for things such as self-dealing or excess business or building holding issues, and do the investment statements provide all of the information that would ever be required for like your net investment income, excise tax, or UBI reporting. And then in our next section, we will move through pretty quickly, but we'll just kind of cover some general tax reporting requirements and disclosures that would arise due to these donations of non-cash assets. So this is just kind of a quick list of what we should consider for non-cash reporting requirements. And of course, the first one here, go back one, here we go, is just the Form 990 and the reporting for non-cash assets. So this is just a really quick listing of where we would potentially see the non-cash assets flowing through on our returns, and also for the Form 990T, just that mention that you're usually filing it because you've got unrelated business income that's come through on something like a K1. And then with foreign reporting, just really imperative to review these non-cash assets, to review our partnerships and those alternative investments, to see if there is any alternative reporting for foreign investments. And the reason here is because these disclosure requirements, if you do not do them, can get you into a lot of trouble. There are some pretty serious and large penalties if you do not comply with these foreign reporting requirements. They go from 10,000 all the way up to 100,000. So we want to make sure that we are aware of those. Same with our state and local filing considerations. So again, If you've got a, publicly traded partnership, those typically have pages upon pages of state information. And so you want to make sure that you're not generating some sort of, nexus or filing requirement in a state each year with these investments, or if someone donates a piece of property, thinking about what your state and local requirements would be for things such as property taxes. And then I'll let Kim kind of wrap up here with our last couple of slides.
Great, thanks, Christine. So yeah, I'm going to wrap up just with some non-reporting donation forms and disclosures. Just again, this is where I was mentioning before, there are differences when we're talking about cash donations and non-cash. So the first form is a form 8283, non-cash charitable contributions. This is actually filed by the donor themselves. So they file it on their tax return. And it's filed to report non-cash gifts over $500,000 or $500. And there's different sections. So the first section is for non-cash gifts of $501 to $5,000 in aggregate, as well as all publicly traded securities. And then section B is if the donor donated property valued at more than $5,000. Key thing to keep in mind here is that if a donor donates property more than $5,000, they are required to have a qualified appraisal. And that's the requirement of the donor. Sometimes we hear organizations talking about, well, I need to get an appraisal in order to accept this. And sometimes the charity might agree to pay for that, but it's really the donor's responsibility for them to get the charitable contribution deduction. The organization's responsibility is simply to fill out section B, part 4, which is the donee acknowledgement, which basically is an acknowledgement that the organization makes that you received the donation from the donor. It also indicates that if you turn around and sell or dispose of that property within 3 years, you're going to file your own form, which is the form 8282. So the 8282 is your donee information return. So this needs to be completed and sent to the IRS after you sell property for which a 8283 was received and signed off for. It doesn't need to be filed if you consumed items in your own use, or if they were distributed out for charitable purposes. So that's an exception there. Key thing to keep in mind here is cryptocurrency, like Christine mentioned earlier, is considered non-cash property. So therefore, if a donor had to complete an 8283 because they gave you crypto that was over those thresholds, and you turn around and sell it, you are going to have to file a form 8282. So that's a big reporting responsibility that could easily get missed if you don't have policies and procedures in place to make sure we're monitoring for what happens when we're getting some of these non-cash contributions. There's also a form 1098C, which is an acknowledgement when you receive vehicles, boats, airplanes of more than $500. So that's a completely different form that you need to complete and provide to a donor when you receive these types of donations. This can be used as your donation receipt to those donors, but one copy is going to get filed with the IRS, another copy is going to be provided to the individual. And I should say the Form 990 asks questions about all of these forms. So it asks whether you've received any assets for which you needed to complete any of these forms. So you're going to have good tracking within your organization to know whether any of these forms were filed and if they should have been filed. And then lastly, just like cash donations, you should be giving written acknowledgement in order for your donor to take a contribution deduction for the donations. not required when the value is small, but it's a best practice to always give receipts out. The key to keep in mind with respect to non-cash donations is there isn't a requirement to report the value. So you don't have a requirement to report value to the donor. It's the donor's responsibility to identify what that value is when they take the charitable contribution. Your only requirement is to acknowledge that you received a certain item of property and the date and then who you received it from.